couple of new voices to this conversation, discuss Lyft's numbers and preview what might come with Uber later today. Angelo Zino, senior industry analyst at CFRA Research, and Dan Primack joining us this morning. You're on the set with us, so I'm going to you first. How much should investors be worried about the lockup issue versus what's actually going on operationally?
Well, I think in terms of the lockup issue, I mean, it was something that was expected. Nonetheless, it's just coming, a little bit sooner than expected. That being said, I think, it's definitely going to be a headwind towards the stock. It's something that investors need to monitor. But the number that we got last night, the results that we got last night from Lyft is exactly what you wanted if you're an investor. I think you need to string another 2 or 3 quarters like that together. You get that, and I think you could potentially see kind of investor sentiment start turning around.
What do you think Lyft is actually worth? 12 months out, if we're sitting here in a year from now, next summer.
So we actually have a 12-month target price of $80. We think the best way to value the stock is clearly doing a DCF analysis, looking at the longer-term picture of the company because of the free cash flow potential in the out years, rather than looking at the actual kind of cash burn that you're going to get here over the next 12 to 18 months.
Hey, Dan, I know you. I know that you're going to sit the day that this lockup comes off, you're going to sit and try to look at the list and see everybody who's trying to sell and what that means. Who is going to sell?
Well, I mean, we will see. I mean, if it goes the way it should go and the way Lyft would expect it to go, kind of those early stage venture capitalists, and when it comes to something like Lyft, maybe the folks who invested in, say, the first 4 years of its life, a lot of those are going to sell because they're not paid to trade, public stock or to really hold public stock. But in theory, with a lot of these unicorns, they raise money from big mutual funds, from big hedge funds. And the idea was those are long-term investors. If they sell, that's an issue.
This raises the bar, Angelo, on Uber tonight, doesn't it?
It does. When we look at Uber, they're a little bit different.
Sure.
Clearly the ride-sharing business is still about 80-85% of their business, but it's really the other bets that they're making. It's the Uber Eats, it's the Uber Freight business, and we're very positive on those businesses. That's really where we expect the bookings growth to come from in terms of Uber here over the next 2 to 3 years.
So we compare those two companies, and we always show the charts of both next to each other, yet arguably, they're two almost different companies, given where the businesses are headed. If you could buy one or the other, which do you buy?
We do have a buy recommendation on both. If I were forced to buy one today, I think Lyft is the better option because I think it's just got the stronger fundamentals in terms of their exposure, essentially, secluded to the U.S. market, whereas we're talking kind of a more broader basis in terms of Uber. So I think there's less risk in the near term for Lyft relative to Uber.
Right. How deep of a breakdown are we expecting in terms of Uber's moonshot businesses?
With the earnings tonight, I think it will be probably pretty similar to what we saw in the IPO. They don't really break out exactly how much, they're marking each business per se every single quarter. So I don't know if we'll get as much of an insight into that. And we probably won't get anything like we saw with the lockup, announcement that we saw in the 8K yesterday with Lyft, because Lyft had something very specific and special in its S1, alluding to the fact that if their blackout period for earnings coincided with their lockup expiration date, they do have this option of moving it forward, whereas typically we see companies move it back.
Tom, 20 seconds only because we saw the screen, because you're Mr. IPO man.
Well, one of the reasons, just for Leslie and Dan, one of the reasons why I really like direct listings, there's no lockups. No. Lockups are such a blunt force, unnatural instrument.
But that's only if a company doesn't need to raise money.
You need the cash.
If you need the money, you have to IPO.
But even in IPOs,
you don't have to do both. You don't have to do both. That's on the
Dan.
SEC. I was just going to say that's right now on the SEC. Like the idea that you can't do a direct listing and have lockups, that's really just because the SEC right now doesn't let you. Someone can do that. Someone will do that. It's just going to have to get negotiated out.